Hello and welcome everyone. Welcome to my YouTube channel. I am Mohak Pachesia, the founder of Technically Sorted, and in this video we are going to be talking about the 5 truths about the market. These 5 truths about the market, which were written in the book Trading in the Zone by Mark Douglas, one of the legendary trading psychologists, and something which has benefited me, benefited a lot of my students. I have recommended his book to a lot of my students. I have read this book again and again and again and again, and have always seen that whenever I read this book, I get a little better. I felt that if I could take out a part of this book and explain this to you in simple words, for those who have not gone through this book on trading psychology, they must understand that the very base and the very foundation of trading psychology is the knowledge about how consistency works. And when consistency involves, what does consistency involve? It involves me, like the trader in question, the market in question, right? So when it comes to me and my trading style, that is a separate discussion. In this video, I'm going to talk about 5 truths which are universally there for each and every trader. Each and every trader has to deal with this. And this is about the 5 truths about the market. So let's go to the first one. The first one is anything can happen. Sounds very simple. But what Mark Douglas wants to say in his book Trading in the Zone is that when he says that anything can happen, it is that as trader, before you sit 9:15, if you're trading the Indian markets, 9:15 a.m. you're sitting, before that you cannot assume certain things. You cannot assume certain things for sure. Of course, you should do your homework, etc. But when he says anything can happen, it is that we have to be as neutral as possible. When we assume that anything can happen in the market, our mind is open. Analytically, we are not biased. We are open to both the directions. And we act as the market asks us to act. Anything can happen in the market is a truth which we cannot ignore. Even if you have taken a trade and it is the best of the trade, it has started working for you quite powerfully so, and it is still the trade is still running, you must have stop losses and trailing stop losses in place, because anything can happen. You cannot afford to have very high number of positions or very high number of positions on one side of the market. Why? Because anything can happen. In my earliest days, I remember one time the market was in an uptrend and I was making some money. I added a lot of different stocks. What happened? The market turned around. I was exuberant, I realized later. But no problem, you learn from your mistakes. And you realize that when in the market anything can happen, it is so important for us to stick to our principles, stick to our money management rules, and stick to our position sizing rules. It is also important for us not to assume anything that will happen for sure. We cannot afford to think like that when we are in the market. No matter how good an analyst you are, you have to accept whatever the market is showing you. The second truth is that you don't need to know where the market is going to, what the market is going to, what is going to happen in the market in order to make money. See, you realize this, that obviously as a technical trader, you're following the charts and you're following the trend. You're trying to find out the triggers, you're looking at the different variables, and you're looking at the most potent variables in that particular market phase too. But then you have to realize that in order to make money, what is going to happen next is just a matter of probability. You cannot know it. And you don't need to know it. Say for example, let's take for example, a certain day the market gapped down and the market was hovering around a support zone for quite some time after the gap down open. So the lower levels were maintained, yet it was trading above a support zone. Now, a friend of mine called me up and asked me, what do you think the market is going to do? I said, I don't know. And he told me, what kind of an analyst are you if you don't know? See, I said, I don't know. I don't have a view as yet. But then, in the second half of the day, the market broke that support zone and I was able to take a trade on the downside. Now, if you're able to take it on trade on the downside at, say, for example, 1 o'clock or 1:30 p.m., and the same chart and the same stock you did not know anything about or didn't have a view about an hour before that, what does this tell you? This tells you that the market movements will happen when they will happen. When you have to take an entry, you need a flow, you need a trigger, and you look for that flow of opportunity rather than trying to be stuck up upon your biasness and trying to fight against the market. You look for that flow of opportunity, and when you are looking for the flow of opportunity, you really don't need to know what is going to happen. You get to know what is going to happen and you act accordingly. That is what patience is about. Now, this second truth about the market which we are discussing, this actually talks a lot about patience. You need to be patient enough for you to almost know what is going to happen in the market, rather than being impatient enough in the thought process that you already know what is going to happen in the market. That is not how trading takes place. Also, when you're running a trade and there are retracements and there's a trend, etc., that time also you need to not know what is going to happen. You just need to stick with your stop loss and have an idea about the potential target that the setup is showing you, the setup is pointing towards. So this is what it means, that if you don't know what is going to happen in the market, it's not that you can't make money. In fact, if you don't, and you assume that I don't know what is going to happen in the market, when the opportunity shows itself, that time you're going to make money. Next, there is a random distribution between wins and losses for any given set of variables that define an edge. Now please understand this. Whenever I say that my system defines an edge, that means it may be subjective, somebody may call some sort of an automated system, etc. But if my set of variables, no matter how subjective or how mechanical they are, I use those variables, I use those concepts to define an edge. An edge means that something which tells me a probability, a higher probability of a stock moving up when my concepts are pointing towards the upward direction versus the stock moving down, and vice versa. In case the market is going down and my variables are pointing towards the downside, then my edge, it means to have an edge that, okay, fine, more than 50% chances, there is a strong chance that the market is going to continue going down, or market is going to get a trigger going down. So when I have an edge and there's a set of variables that define the edge, okay, excuse me, so I might use, say for example, an indicator. I might use the combination of a couple of moving averages. I might use the support resistance levels. I may use multiple time frames. I may look at data which is pertaining to the derivatives. I may look at volumes, etc. So whenever I look at these different variables that are going to define, a sum total of these variables are going to define my edge and my setup. When my variables are pointing towards a direction, I have an edge. Please understand, the edge means that there's a slightly higher or a strongly higher possibility. It does not mean that there's a certainty. So maybe out of 10 times, I can be right 9 times or 8 times. Or let's be conservative and say that out of 10 times I'm trying to predict the direction of a stock movement, I'm going to be right 7 times. In these 7 times, when I'm right, I want to become right in a big way. I want to catch the bigger moves, significant moves, tradable moves. Whereas if I'm looking at the losses or the 3 losing trades, I want the stop losses to be small. Therefore, what I need to understand over here is that when I'm going to take a string of trades, a series of trades, I don't know which one of these will be losses. So if I start with trade number 1, go to trade number 10. I don't know if the first, second and third will be losers, or the second, fifth and ninth will be losers, or what kind of distribution of the wins to losses will be. Therefore, it is called a random distribution. I might win, lose, win, and lose 2 trades in the end. So at the end of these string of 10 trades, I have to understand that there's a random distribution. And because there's a random distribution, I cannot say that every single time I'll be right. that wrong trade may be around the corner. And if I've taken a wrong trade and I feel demotivated that, oh my God, how can I trade now because I just got a loss? No. Maybe right after that, the right trade is around the corner. So because this distribution is so random, from moving from one trade to the next, I cannot carry the excitement of a profit or the dullness and the depression of a loss to the next trade. So I need to take all these 10 trades, which are the series of trades, with the same clarity and mindset and accept whether there is a loss or there is a profit. When there is a loss, move on to the next trade. When there is a profit, therefore, then also move on to the next trade, keeping the position sizing and the money management principles similar or same. Okay. Now, this was the third one. Now, the fourth truth about the market. An edge is nothing more than the indication of a higher probability of one thing happening over another. I think we covered this. The fact that when I say that I have an edge, when I know a method, when a setup works for me, a method works for me, okay, or trying to understand through patterns how mass psychology behaves, works for me. There's a high probability, or I'm pretty accurate at predicting the markets or trading the markets. But what happens when I say that there's a high probability? It is just an indication that I might be right. It is not a surety. So please understand that this indication is what your edge is about. No matter how good you are, you can be the best and you can still be wrong on a trade. Unless we accept that, we are not going to be able to trade consistently because emotions will become a part of our excitement after winning. And that's where most people trip. Next is, every moment in the market is unique. Every moment in the market is unique. This is a profound thing which Mark Douglas wrote. Please understand that at every time frame we are looking at price movement. There is an infinite stream of opportunities from now till the end of your life and even after that. The market is going to move continuously. And every time we see similar patterns, when we see our edge working out in similar patterns and similar structures of many different stocks, that edge, those patterns, those indications, those signals are just very much pertaining to that particular time and phase of the market. It is pertaining to that, but it is something similar to what has happened in the past. It is similar, but it is not the same. So every time we see a fresh market, we see a gap up, the market has gapped up. Now a newcomer will think that last week also I saw the market gap up and this behavior happened. And I see the market is gapping up now, so I'm expecting the same thing to happen. No. Every moment in the market is unique. So everything will lead to a different follow-up of the price. So you cannot just use one or two variables. You have to understand that an entire setup is made with number of variables so that in the past when you saw the same thing happening or similar thing happening, you can map it to the current phase of the market. It will mean not exactly the same thing. It will be something completely unique which has never happened in the history of time before and never going to happen again in the history of in future. Okay, so make sure that you accept the fact that every moment is unique and your analysis is just leading you to map this phase and scan this phase of the market in a way which may be similar to something in the past. It will be similar, but it will be not exactly the same. So this, I think, the learning we can take from this particular truth is that we should learn to have our expectations in moderation. Many people see, okay, last year I traded this stock, there was a similar breakout and the setup was similar, everything was similar. And this year I see the same stock, a different stock in a different sector, and the price structure is totally same. I'm expecting the same thing to happen. No, might not be. It might be that the stock is moving in a different trajectory, in the same direction, but in a different trajectory. in the same direction, but with different kind of momentum, with different kind of flow, with different kind of extended waves. So you have to keep your expectations in moderation and understand that although the direction and the magnitude and everything counts in your analysis, it might not be so that you will be able to be have what you expected. Sometimes you have to book profits even though the highest potential profits is not achieved. Okay, sometimes you have to take up a trailing stop loss, and sometimes you get far more than what you thought. I mean, sometimes a scalping decision where I am looking for say 20 points that leads to a trade which actually ends up giving me about 200 or 300 points. Okay, so please understand these things and try and catch hold of this book, lay your hands on this very interesting read, Trading in the Zone. And I hope you understood this video. If there are parts of this video which you have not understood, you might want to go rewind and look at the learnings once again. Ask yourself, what is in it that resonates with me or my experience in trading? Thank you so much for being there. To know more about us, go to the links below and check out my website www.technicallysorted.com. Thank you so much. Take care. Goodbye. Enjoy.